contact information, my phone number and my email address. Email is the best way to reach out to me. But if if you can write this down right now, you can just go to mayocreditunion.com or .org, and you can go to financial education, and my contact information will be on there as well. Again, my name is Soga Hughes. I've been in the personal finance industry for almost 20 years, and I've been in this position for going on 4 years. It's something I'm absolutely passionate about. I mean, so many different people from all walks of life, different journeys and their different positions in their financial journey. So wherever you're at, I'm so glad that you're here now. And if you need help, if you just need someone to just talk about with your personal finance, if you know someone that needs help, have them reach out to me and I'll be more than happy to help them out. So today we'll talk about just general financial wellness. We're going to talk about budgeting, savings, managing debt and credit, student loans. We're going to touch a little bit on student loans. It's ever changing. It's a hot topic here. It's a hot topic nationally right now. We're going to talk a little bit about retirement and financial planning, managing your money and watching out for scams. Now, I think it's in next week or in a couple weeks, Stephanie's going to put on a wonderful presentation on scams and frauds, so be sure to sign up for that as well, okay? So when we talk about budgeting, we want to talk about setting a budget, but we want to be realistic about your budget. So how can you be realistic about setting your own budget? It starts out by auditing your own accounts. So you don't know how much you're actually spending until you actually go through your accounts and try to figure out what it is, what's the category you're spending a lot of money on. A lot of times people come to me and they say, you know what? I'm making this amount of money. I have no idea where my money is going to. I don't know why I'm getting overdraft fees at the end of the month. I should have more than enough to cover all my expenses and all my outings and things like that. Well, when you start auditing your accounts, which I advise people to do every statements that they get, kind of go over just to make sure that everything is on there, is not fraudulent, make sure everything clears on there. And just kind of audit your account and see, how much are you spending on eating out? Do you actually think that you're spending $100 a month on eating out, or is it realistically more like $600? And if it is, then you're over your budget, and that's probably where all your money is going to also. But when you're auditing your accounts, it's really, you get to see where maybe you have some subscriptions, maybe you have some, some subscriptions to maybe a makeup place like Ipsy, or maybe you no longer want to subscribe to Peacock or Netflix, and you can recognize that you don't need all those things, and you can cancel those as well. So it's a great time to kind of just take an overall look at your account and see what is actually coming out, if it's accurate, or if you need to change anything. So when it comes to setting budget, we want you to be realistic. And it doesn't have to be the same budget for this month, the same as 6-7 months from now. We want you to kind of adjust it a little bit depending on the seasons of your life, the season of the year, whatever it is that the kids have going on too. So, of course, we want you to keep track of your spending, your daily expenses, just so you know how much you're spending and how much is going out, how much is coming in. We want you, of course, to build healthy habits when it comes to your finances. It starts by establishing and understanding your credit, how important credit is in this society, how important credit is to get certain positions, certain jobs, how important credit is to get a good interest rate, and how you can save money with good credit. And of course, we want you to start the habit and continue having the habit of making all your payments on time. There will, of course, be times when you can't make your payments on time, and that will be fine too. Just reach out to your creditor ahead of time, let them know what's going on. That way they can try to work with you and just, be a partnership with your creditors, see how they can help you get back on track. Of course, we want you to start building your savings. If you don't already have an emergency savings, let's go ahead and start that. How do you start emergency savings? We're going to talk about that here in just a little bit. But what is why is it important to have savings? Why it's important to have financial goals? So those are some of the things where we want you to establish that really early on in your financial journey. But if it's not early on in your financial journey, wherever you're at now is a great place to start too. Some of the financial goals I want to talk about, we want you to set financial goals, of course. That way it helps deter you from overspending on just frivolous things, right? The Memorial Day is coming up. There's a lot of Memorial Day specials going on. And if you say, you know what, I want to go to Italy in October. I need to buy my tickets by August or September. If I don't overspend on this Memorial Day couch set, which I don't really need, then I can save that money towards, going to Europe. So that if you have financial goals that you want to set, that'll be a lot easier for you to keep track of where your money is going to and how you want to spend your money. So when we talk about short-term goals, it's typically things that you want to achieve within less than a year. Those are things like you want your emergency savings set up. So emergency savings doesn't have to be a lot to start with. It can be something as little as $1,000. You know, you can set out $100 out of each paycheck for the next 10, 10 paychecks, and that will come out to $1,000. You can start with 1,000, you can start with 1,500. As long as you set an amount, stick with it, and have a due date for that goal to reach. So that way you know exactly when to hit it. It can be things for travel or for wedding, if you're having a wedding yourself or you're traveling for a wedding. So those are things that are typically short-term goals, okay? When it comes to medium-term goals, it's things typically about 2 to 3 years. You want to save, let's say for a down payment on a house. Down payment on a vehicle is typically a little bit more for a house. You want to pay off some credit card debt and stuff. We want you to kind of have that as a medium-term goal. Of course, short-term is a lot better, so that we can, achieve it a lot sooner. But if you can't, then having a down payment on a house is typically a little bit more expensive. So we can aim for 2 to 3 years for that. When it comes to long-term goals, that's several years or decades away, okay? So wherever you're at now, just think about what you want for retirement. When it comes to how much retirement funds you actually need, what kind of lifestyle you want to lead when you retire. Do you want to travel the world, or do you want to just travel Minnesota? That's going to be different expenses. So if you're with Mayo Clinic, you can talk to Fidelity or Idaman Financial, but about your, with your financial advisor. But if you are not with Mayo and you don't have access to those folks, we have a wonderful team that we work with, Cetera, here at the Cascade location. You can talk to any of the advisors about your long-term financial planning. They'll be more than happy to meet with anyone. And also, is your long-term planning to pay off your mortgage? Is that 10, 20, 30 years from now? How are you going to pay that off? Do you want to pay an extra payment each year, an extra half payment each month, or how do you want to achieve that? So it's really important when you think about your budget. It's not just about, maybe I shouldn't buy Starbucks today. Maybe I should buy Starbucks next week. It's not about that when it comes to budgeting. It's about how do you want to live your life now? How do you want to live your life in about 2, 3 years? How do you want to live your life when you retire? What does that look like for you? And we want you to enjoy the life now. We want you to enjoy the money that you're making now. So if Starbucks is something you can't cut out, let's just have a budget for that. But just stay within reason. If you're going out to eat 5, 6 times a week and it's costing you an extra $500, $600 a month, let's just cut that back to maybe once or twice a week. We want you to tailor it to your lifestyle now, but we want you to keep focused on whatever financial goals that you have coming up, whether short-term, medium-term, or long-term goals, okay? Any questions on here so far or on YouTube? No? Okay, perfect. Now, this is a very basic budget spreadsheet. You can actually make your own. You can do just a piece of paper, write down how much you make, what kind of expenses you have. You can actually go online, but there's plenty of apps online too that you can use and download for free. But the basics of budgeting is know how much how much money you're bringing in. I was surprised when I started this position how many people don't actually realize how much money they're bringing in. The difference between gross and net income, which is fine if you don't know the difference, but at least have an idea on how much you're bringing in, how much your spouse or significant other or the other party is bringing in, and also make a list of what kind of expenses you have. So we can start out with fixed expenses. These are easy. When you have the fixed expenses, you know exactly what's coming out. You have the, a rough amount. For example, if it's cable, it's going to be a couple dollars off each month. But you pretty much know how much your mortgage is and when it comes out, how much your car payment is and when it comes out, your car insurance, things like that. So those are considered fixed expenses. They're predictable and they're pretty much the same amount each month, and the due dates are on the same date each month. Now, this is where the next category is variable expenses. It fluctuates. This is where you make or break your budget. This is life. This is the life portion of your budget. We want you to spend money on groceries. We want you to spend money on going out and having fun, with your family and friends, having hobbies, have personal care, things like that. We want that. We want you to ideally have a budget for that. Have a budget for each category in life so you know exactly how much that you have to spend. So that way when you do spend it, you don't feel guilty spending it because you have that amount allocated for that category already. So a lot of people don't realize, maybe I spent $200 extra on Quick Trip because every time you go in, it comes out to $8 or $11, even though you're only supposed to go in for maybe a donut or so, right? That's realistic. So typically, the variable expenses is where it fluctuates life a lot. And, when it's a little bit easier during the weeknights to go out to eat with kids and stuff instead of cooking at home, I get it. So, but at least have a category for that and have a budget allocated for that so you know exactly how much you have left at the end of each payday or at the end of each month so you won't go over your budget. Because we want you to stay within that budget because we want you to save towards your short-term goals, medium-term goals or long-term goals. So keep in mind of those financial goals, okay? So it comes down to how much you make minus how much your expenses are, minus how much does life cost. And then also, I want you to get in a habit of putting your financial goals as part of your monthly bills as well. Make your financial goals, make that savings mandatory for you to pay it back. Just like you have to pay back your phone bill each month, let's go ahead and pay towards the Christmas savings category. Let's go back, let's make new tires category mandatory payment as well. That's how you pretty much just kind of force yourself to pay, not see how much is left over, but use that as part of your bills as well. The easiest way to save something, if you're with, Mayo, for example, you can do a payroll deduction where they can automatically deposit a certain percentage or a certain amount of money out of your payroll directly into that savings account or checking account. It doesn't have to be with your main savings account or your main checking account. Put in a separate savings account that you don't really have access to that easily. I mean, when there is an emergency, you at least have a card to go to the bank where you can get the money out. But at least not have it with your regular checking account, or just have a separate savings account with that same institution as well. So that way you know that this is for emergency purposes only. Emergencies doesn't mean sales is ending today. It means tire blew out and I need to get new tires. It means that your air conditioner went out and you need to get new air conditioning, a new air conditioning unit. So that's considered emergencies. Any questions on this stage so far? No? Okay, perfect. Now, ideas to reduce expenses, we can all get pretty creative, but some of the ideas that really work for me and some of my members, when you change your cell phone plans, I recently switched from, I was with Sprint for a long time, and then T-Mobile bought them out, and then I recently switched to Spectrum, so I was paying like $127 a month to where now I'm paying like $62 for my line. And I didn't think that it was gonna make that big of a difference until I started shopping around, because I was stupidly loyal to one company that didn't really care if I kind of switched or not, So it's great that you want to have all these features with one company and you feel like, you're loyal to one company. That's wonderful. But once you start shopping around and see how much you can save, ultimately, they're just going to let you go and you can save your money with a different company. So it's great that you want to be loyal. There's a lot of brand loyalty out there. But when it comes to you saving money and reducing expenses, I think shopping around for cell phone plans is one of those, one of those plans that that you need, you use all the time, and might as well just go with a cheaper one. They provide all the same services anyways. They're very competitive right now. Another way to save money or reduce expenses is to cancel your gym membership. So it's nice and warm right now. It's going to get better. Do you like to be outside? Do you prefer to be in the gym? Or if you're with, like say the rack and it costs you $100 for a single person, are you really going every day, or are you going to be more realistic with yourself and say, maybe I should just kind of get with a gym that's a lot cheaper, that I know that I can, get to easily every day versus going to a nice fancy gym like the rack and have all those amenities that you don't really use. So just a lot of people that I know kind of put their gym membership on pause during the summertime, just so you can go out there and enjoy the natural sun and stuff. Cut streaming services. So again, when you audit your accounts, you're gonna see, my goodness, why am I subscribed to 8, 9, 10 different streaming services that's coming out to $100 a month? I started with the streaming services because I want to save money from cable. But now, all these Peacock's like $5.99 a month. You can get Hulu for like $7.99. I think Netflix have a special that's like $7.99 right now too, with limited commercial. But you get all these little things that are included, and it comes out to about the same price as cable now, so you end up wasting more money. So when you audit your accounts, you realize that I don't need all this stuff. It's not football season right now. I don't need Hulu Sports that costs like $87 a month. Let's just go ahead and cancel it for now until football comes back on or whatever it is, the situation. Another thing to really consider is moving out of checking account and savings account with monthly fees or minimum balance requirements. So I think with US Bank and with Wells Fargo, if you don't do a direct deposit of like, I think $1,500 a month, they charge you like $15 of maintenance fees. There's no need for you to pay for any of that. Here at Mayo Employee Federal Credit Union, we don't charge any of that. You can have as many savings accounts as you want and checking account. We won't charge a service fee. We just, require you, of course, to stay above zero. If you do go below zero, there's NSF fees and things like that, just like with any other banks. But if you're with, those large institutions that charge that much, there's no need for you to stay with, for you to stay loyal with that kind of company. just move on over to another institution that won't charge you a monthly service fee. Another thing to save you money is to refinance loans or to lower your interest rate. So maybe a couple years ago, your credit wasn't that good, but you need a vehicle, so your interest rate was really high, right? So the lower your credit score, the higher your interest rate. But now you've been working on improving your credit, and your credit score is a lot better. So you can take your vehicle loan, you can try to refinance it and try to get whatever equity out of the loan, or same thing to refinance your home too, to try to, or to get refinance your mortgage to get a lower interest rate. Same thing with student loans as well. The point here is we want you to tailor your goals to your lifestyle. So whatever it is that you find that you think that you're spending too much money on, go ahead and try to figure out a way how to reduce the expenses in that lifestyle, in that on that side of it. Another thing that we want to talk about that's really, really important that we need to focus on more is savings, right? So when it comes to spending, that's easy to do. When it comes to savings, it's not a sixth sense to a lot of people. So we have to manually and consciously work towards savings. The easiest way to do that is to go ahead and automate your savings. So when it comes to emergency savings, we want you to have those emergency savings just in case something happens, there's an emergency. We don't want you to put it on your credit card because it'll just put you further into debt. Because when we're trying to save money, we're trying to get rid of debt as quickly as possible. So again, we want you to set goals and automate your savings from your paycheck or directly out of your checking account to a separate savings account. That way you can eliminate yourself as the middleman. Because if you find that you're too tempted to spend money, to use that money instead of savings to buy something else, and then you keep telling yourself, you know what, I'll just save more next paycheck, this, that, or the other, because there's a good sale or a good deal that's going on, whatever it is that you want to spend your money on, go ahead and, eliminate yourself out of the situation and just do an automatic transfer. Just have it automatically, each paycheck, to deposit into a different savings account. So we want you to typically have between 6 to 9 months of living expenses, okay? That's a big number. That's a huge and overwhelming number. It can be intimidating for a lot of people. So start out with 1 month. You have your emergency savings of, let's say, $1,000. Now the next step is to go ahead and try to save 1 month of living expenses. And the other, an example before, that 1 month of living expenses was about $4,900. So maybe give yourself about 3 to 6 months to save for that 1 month of living expenses. How much does that come out to each paycheck? And then you would just automate that amount to automatically transfer to that to a separate savings account. So that would be a good step to take too. And then next thing you know, eventually give yourself about a year or so to save up your 6 to 9 months. Maybe it takes a year, maybe it takes 2 years. For some people, if it's in your budget, maybe it's a short-term goal for you. But if it's not in your budget for a short-term goal, let's make it a medium-term goal. Let's say by the end of year 3, you'll have 9 months of living expenses saved in a high-yield savings account or in a money market account, okay? So again, with short-term goals, determine an amount and set that goal and make sure you have a set date, right? So we want a goal to have a due date so we know to work backwards. We know that, you know what, this is when I want it done by. So we have to do everything we can to get it done by this due date. Those short-term goals will be, again, car down payments, moving expenses, vacations, things like that. Medium-term goals, we want to determine amount and set date too within 2 to 5 years. Long-term goals, again, determine the amount and set the date, things like the house down payment, investments, and retirements. Different ways to accumulate more savings. We want to, of course, always back again to setting goals. It could be habitual or financial goals. Sometimes, habits and finances go hand in hand. If you realize that when you're stressed and you like to go shopping, maybe, put you further into debt, maybe when you're stressed, maybe just take a walk outside or something. So that can be habitual, changes too. As long as you recognize what is your relationship, what is your, what is your generational relationship to money? Did you grow up seeing your parents struggle with money, and then whenever they get, whenever they get paid, they buy extravagant items? Is that what you do too when you get paid, when you get a lump sum of money? Do you recognize that within yourself? So if you're able to set goals, you're able to review how your spending habits are. That way you can review how your relationship with money affects your mental health and affects your financial habits as well, and your financial goals. And again, we talk about automate savings. That's the easiest way to save money. When we talk about meal plan and dining out, that's a lot easier said than done, especially if you already built that habit of kind of eating out every Monday, Wednesday, and Friday. it might be easier for you and your family to eat out that much. But if it's in your budget to eat out that often, let's go ahead and keep it in your budget, but maybe lower the grocery budget a little bit. Because if you're going to be eating out more often and not cooking as much at home, then maybe you don't need that much groceries at home. So whatever it is, just kind of be realistic of where your finances are going to, where your areas of spending is at. And remove your payments, your payment information from sites like Amazon or Target, or even unsubscribe to certain emails, promotional emails and stuff. If you're trying to save money and you're trying not to be tempted by all these savings and things like that, it's best to go ahead and just unsubscribe to those emails. You won't get those emails. You won't be tempted to see how much you'll be saving, how much the sales is, things like that. So when I was on maternity leave, I had to take my payment information off of Amazon simply because I was just holding my baby while he was sleeping, and then it was easier for me just to do the one-click shop, right, from Amazon. But it was like getting out of control because that's all I was doing. So in order for me to stop doing it, I just took my payment information off of Amazon, and it just kept it in my car, and if I want to buy something, I had to get up to my car to get my card to put in my information. It can be something as simple as that to keep you from overspending. And it's really, really easy to just do that one click, especially the online order with Target, with Hy-Vee, whatever it is you choose to shop at. It's really, really easy to overspend online, especially when it doesn't really feel like real money. And you can also sell your items, items like your clothing, your baby gear and stuff that you don't use anymore, your household items, whatever it is that you don't use anymore. Have a garage sale. It's the season of garage sales right now. So it's a great way to make, a quick money. Even if you go with your neighbors and just joining with your neighbors and try to sell something too, do a garage sale that way. And if you're able to, get another gig or a part-time job. It's a gig economy right now. You can just download an app and you can, drive for Uber. You can do DoorDash and stuff, and you can get paid. I think every Friday is when they pay it. Yeah, and other ways to save that we have available here to help you save money. We have high yield savings account. We have certificates, youth and teen certificates. We have the educational savings, the 529 plan, that you can start saving college funds for your kids or grandkids. And we also have traditional Roth IRAs here, and also pre-tax savings and pensions as well. Next, we'll talk about managing debt and credit. Your credit profile is specific to you, so you and your spouse can have the same stuff on your credit report, but your credit score might be completely different than your spouse that has the exact same thing, because maybe they have a credit card that's been on there a lot longer than you've had your credit card. So whatever it is, it's very specific to you. But it's very important that you understand how your credit score is calculated so you know how to improve your credit score. We want you to make thoughtful and deliberate choices, of course. Is this an emotional buy? Are you in a manic situation where you're just out to spend to make you feel better? We want you to kind of monitor how you feel when you buy those things. If you don't need it, are you buying it just to make yourself feel better? Are you buying it because you're bored? Are you buying it because you're influenced by, social media to buy it? Or what's the reason why you're buying these things when you know you don't need it, when you know you have other financial goals that you want to meet first? We, of course, want you to monitor your credit report at least once a year. At the beginning of the pandemic, and throughout the pandemic, I believe annualcreditreport.com can let you pull up your credit report every week. And now it's, I think you can pull it almost as often, but we prefer that you guys just check it once a year. So it's a secured website, annualcreditreport.com. It's free. You can get all 3 credit reports on there as well. So you can get it from Experian, TransUnion, and Equifax. Yes, sir?
What's your feeling about your credit score and having it froze so that nobody can get into it?
Oh, sure. So the question is, what is my feel on my credit score and having it frozen so no one can get into it, right? Is that the question? So my feeling is great. So if you think that your credit score might be at risk, or if your credit report might be at risk, it's really easy to just freeze your credit on there. With each website, with each Equifax, Experian, and TransUnion, you can actually just freeze it. It takes a couple seconds to just log on and just say freeze your credit. So that means that when you freeze your credit, whenever a creditor pulls up your information to try to get a loan or whatever it is, you'll probably get denied for the loan because your credit score is frozen, right? Your credit's frozen. So then you'll get a notification to see if you want to release this information or not. And when you want to unfreeze your credit, all you have to do is just go back on the website and hit unfreeze credit. It takes just a few seconds, but it saves you a lot of money if you think that you could be, a victim of fraud or spam or things like that. So yes, I think my feelings are that it's very positive to have that feature available. Did I answer your question? Wonderful. And it's really important to have good credit, right? So good credit, in this society, it's, financial society, it's really, really important for you to have. The higher your credit score, the lower your interest rate will be. The lower the interest rate will be means the more money in your pocket. So for example, if your credit score is not that good, you're trying to get into an apartment, of course they check your credit score, they check your rental history, things like that. But if your credit score is not good enough, they may require you to have a larger deposit or down payment. You may need to get, a secondary signer on there, or, they run your credit when you try to get car insurance too. So of course they look at your driving history, but the second factor they look at is your credit score too. So it's really important that you have good credit just to get the best premium possible out there. And also there's certain jobs and positions that require you to have good credit as well. So it's just all around, just understand how your credit works. Try to have the best credit score possible. And if you don't, then you can always build back up too. So again, annualcreditreport.com, or call this phone number. And if you're having a hard time pulling up your information or need help reviewing your credit report, just let me know too, and I can help you with that. What you want to look for when you pull up your credit report is make sure your name, address, phone number, employer, your creditors on there, your payment history is all accurate. Make sure you pull up all three, because maybe Experian hasn't reported what Equifax and TransUnion has already reported. They are, every creditor, like for us, we have to report it every 30 days. So maybe there's Capital One and American Express that hasn't reported yet, and it's kind of affecting your credit score a little bit too. So it's really important that you review everything to make sure it's correct, and if there is fraudulent activity, so you can report that on there as well. So credit cards is really good. It can be a helpful financial tool for you if you use it responsibly. It helps you build your credit score, right? And it helps you, it's really easy to manage online. Even if you have like a fraudulent activity on there, you can just call your credit card company, let them know there's a fraudulent activity, they freeze your credit card, they can give you a new credit card and get your money back, and while they do their investigation and everything. It's really good. You can earn rewards, but it varies by card, right? But the interest rate varies depending on what your credit score is like. But it also can create unnecessary debt when not paid in full, if you haven't created a payment plan for bigger expenses. So yes, it could be a great tool, right? But there's two types of people in this world. You're either a credit card person or you're not a credit card person. And unfortunately, you don't realize you're not a credit card person until you get credit cards, and it turns out that you're overspending on your credit card, you're not paying everything back, and next thing you know, you're over the limit, and now your credit score is tainted. So it's just really important that when you do get a credit card, just know that it is real money back there. It's money that you have to pay back with interest. So a lot of times people, like I said, you keep your credit card information online to do online shopping, but it doesn't feel like real money. It's just a number on there. It's just a figure on there. Like, I can just pay this back onto my next paycheck. What happens if you get sick and you don't have enough sick hours to cover that paycheck, and you don't have enough money to pay back your credit card? You just have to think about that. When you're spending on your credit card, you're actually borrowing money that you don't actually have right now. You're borrowing against your future. So just be mindful of that. So different types of loans that we have here, but also, except for one, and then different types of loans out there. Of course, we're all familiar with student loans, right? So depends where you're on your student loan journey. Sometimes it could be a mess, sometimes it's not. Some people, it's just, it's everywhere right now, so it's ever-changing, industry. Personal loans, we all know what personal loans are. You go to a bank, you go to a credit union, try to get a personal loan to pay towards whatever it is you need. Vehicle loans, we use that to buy vehicles. We have mortgage and home equity loans available here as well. Another loan that we don't have, thank goodness, and it's illegal in a lot of states, or about 15 states now, is payday loans. It's exactly what it sounds like. You get a loan online, it takes a few minutes to get approved because they don't pull your credit score, and say, you know what, I'm really desperate. My utilities are going to get shut off within a couple days and I don't get paid until next Friday. What do? I need to keep my lights on because I have kids and, I have pets or whatever the reason. So you go online, you type in payday loans, and you can type in your information, you provide your bank routing and checking account number for them to deposit money into your account. And they say, you know what, you've been approved for $1,000, but on your next payday, next Friday, you have to pay back $575 of that, and then the next payday after that, you pay the remaining balance, but not really, because we're going to include, we're going to have about 200% interest on there, so you're going to pay another $300 or something just to pay off this $1,000 loan or what have you. So out of $1,000 that they deposit into your account, you're now paying back about $1,300, $1,400, but you have to pay it every payday. But then you call on the second payday and say, you know what, the first payday is fine, I have money available. But the second payday, now rent or mortgage is due, and I don't have enough money to pay for that. Can I get an extension? They'll say, yes, of course you can get an extension, right? Because they're charging you a very large interest rate. So now the second payday payments is now extended to 3 or 4 payments. Next thing you know, you're paying about $2,000 on this $1,000 loan. So then it's a vicious cycle. And then what do? My gosh, my utilities is due again. I don't have enough money because I'm busy paying off this loan. Now I'm going to get another payday loan to try to catch up again. It's a vicious cycle. It's hard to get out of. Another thing that's hard to get out of is buy now, pay later products. So when you go on Amazon, when you go on different, shopping places now, they offer, you can apply with Klarna, apply with Afterpay, and for this product, all you have to do is pay it in 6 installments every 2 weeks. You only have to pay $15, right? $15 every 2 weeks, you'll get this paid off, but you get your product now. So it's kind of like layaways back in the day, right? In Kmart or places like that. But now, layaway, you have to pay it all off before you get your products, but now you get your product first and then you pay it back. But it's just a little payment. Every payday or every 2 weeks, every other Friday, you pay $15 towards it. But it's so easy to slide down because then when you buy more products, they say, you know what, just pay $25 for this product for the next 6 installments. And then next thing you know, people have like 6 or 7 installments. Yes, you have a question?
Question about the payday loan.
Yeah.
There's something newer to me anyway.
Yeah.
Same day pay.
Oh, yeah.
Is that the same thing?
Same thing, yeah. They just like to rebrand it, rename it. Same day pay, so you can apply for it. You can get that pay, a deposit into your account that same day. So same day pay.
If it were through, say, an employer, it's still, you're paying way too much.
Yes, yeah, absolutely. So it's just like kind of a loan that has a very high interest rate. They typically don't pull up your credit report. So if you haven't, if you have not established a bad relationship with them, chances are you get approved for it. But you just have to pay it back a lot, with a lot of fees on top of there. Yeah, absolutely. So this is a breakdown of your credit score, how it's determined, right? 35% of it is your payment history, of course, because they want you to see your history and how well you pay back your credit, your credit card, your loans, your installment loans, revolving loans, things like that. So it's really important. 35%. 30% is how much you owe. So that's credit utilization. Typically, we want you to stay under 40% credit utilization, so that way you have more credit that's available. It shows you have discipline to not spend all your money. New credit takes up 10% of your credit score. That means that whenever you apply for new credit, now remember you're shortening the length of the credit history. So credit history takes up 15% of your credit score. So whenever you get new credit, remember you're getting a hard inquiry hit on there. So your credit score goes down by a little bit. But also you're lowering your credit score too because you're shortening the length of the lifetime of your credit history. And a credit mix takes up about 10% of your credit score. Typically a good credit mix would be like a mortgage, student loans, car loans, personal loan, credit card. So that's a good credit mix, right? But if you don't have those things, that's fine too. Don't go out to get it just to increase your credit score. The point here is the most important thing is your payment history and not overspending, not going over the credit utilization. So that's, again, credit scores is personal to you and to your lifestyle. So it's very important to know that maybe if you miss a payment, your credit score only goes down by a couple points. But if you're someone else that has pretty much the same stuff on their credit report, miss their payment, it may go down by 100 points. So because it depends on so many things, right? So it's different. Any questions on credit score? No? Okay, perfect. So again, we talked about the payment history. Pay your bills on time. And if you miss a payment, get current and stay current. But if you don't think you can pay your bills on time, just contact your creditor, let them know what you're going through, and they can be more than happy to work with you. I worked in collections for 16 years. Trust me, we're more than happy to work with you. We want to get paid just as much as you want to pay us, all right? So if you don't think you can pay your $500-600 car payment, let's go ahead and do a payment plan from that payment plan too, and then we can maybe look into deferments and things like that. So don't be scared to talk to your creditor. They're there to work with you, not against you. And the amounts owed, so credit utilization, I mentioned 40%, so we typically want it to be between 30 to 40%. It helps determine how well you manage your current debt. The length of credit history, the average age of the oldest and the newest account together. Don't apply for unnecessary credit. I understand with merchant accounts, if you apply with us here, you get approved, then you can get 30% off of your purchase with us right now. But what they don't tell you that is it's going to take a hit on your credit report because they're doing a hard pull on your credit inquiry. and you're getting a new credit, so it shortens the length of your credit history. So you want to limit the new credit inquiries. You want to apply for and open new credit cards only as needed, and have credit cards, but manage them responsibly, of course. So we talked about the credit mix. It shows your ability to pay it back. So revolving installment accounts, with student loans, mortgage, car loans, and stuff like that. But again, don't go out there just to get those loans, just to get a good credit mix. The most important thing, again, is to pay it back on time, your ability to pay it back. So when it comes to talking about good debt versus bad debt, mortgage, typically good debt because you can, for the most part, you get equity from it. You can use that equity towards another, to open a business. You can use that equity to refinance your home. You can just use that equity for later on in life too. Vehicle loans, unless it's like a collector's item, it might, not be a good debt. But typically, when I think everyone, at some point in their life, gets a vehicle loan. Not too many people can afford $20,000, $30,000 straight off the bat to pay for a vehicle right away. So it's always good to make sure your credit is good so you can get a good interest rate on your vehicle loan as well. Investments is good, but you don't want to take out a loan to invest in the market or anything like that because right now with our interest rate the way that it is and the rate of return, then the investment might not be worth it too. Education, I guess it depends what you're going to school for, right? So if you're taking out education loan to go for a position that you're going to use later in life, then that would be a good investment for your future. But if you're taking out $100,000, $200,000 in student loans, and you're going for theater, and you're not going to do anything in theater later on, something like that may not be a good investment. Depends. I'm not picking on theater people. It depends what it is. If you're not using it later in life, it might not be the best investment. Credit cards, if you use it responsibly, you can get a lot of good points back. If you kind of learn credit card hacks and stuff and follow through with it, make good payments on it, it might be considered good debt depending on what you do with it. But for the most part, with a high interest rates, with the risk of you slipping down the slope there by not paying your credit cards on time, may not be good debt for some people. So you're taking out a loan to invest in a business. It'll be good debt if the business is successful, right? So you determine whether it's good or bad for you. With store credits, I always typically say it's not always the best. But the interest rates are always really high. It's always maxed out between 27 and 30%. Paying lenders, we talk about just how bad that is. So when it comes to managing debt, now we're going to talk about managing debt. So debt repayment, you figure out what kind of debt repayment is good for you. So the first things first, of course, find out what kind of debt you have. You can pull up your credit report. You can go to your, have a list of your bank statements or credit card statements and see what you owe on your loans and stuff like that. So first thing to do when it comes to debt repayment, figure out what you owe, who you owe, what your interest rate is, when your due date is, when your estimated payoff dates, so the maturation date. And then you determine which debt repayment plan is best for you. Is it the envelope system that's good for you? Will that work out for you for the long run? Will it be the debt snowball or the debt avalanche program? Whatever it is that you choose to do as a debt repayment program, just make sure that you're able to stick to it and just be realistic with yourself, right? We all want to pay off our debt, within 6 months as soon as possible. But is it realistic with your budget? So that goes way back to the other slides when we talk about budgeting. Do you have a section for debt repayment? Is it available for you to pay $600 a month, or is it more realistic for you to pay $60 a month? And determine, is it the debt snowball where you list off your debt from the smallest debt to the largest debt first, and you pay it off by size that way? And then the avalanche is when you list it off by interest rate, the highest interest rate first, and then once you pay off that high interest rate, then it's a lot easier for you to pay for the smaller ones too, for the smaller interest rate too, because then because it's an avalanche. So when you pay the bigger bills with the larger interest rate, it kind of avalanche down to the smaller balances too. And so you decide which one is good for you. We can explore all of them together. And if you find out that, for the first couple months, that debt snowball is not good for you, let's jump to the debt avalanche and we can work on that too. Some people just kind of go old school, which is now popular again, which is the envelope system. You put cash in that envelope, a physical envelope, and you determine, is this good for you? So this is how much you have to put towards this debt. This is, you save this much, let's go and offer a settlement on this debt, or if that works out for you. But you want to create a budget and know when you need to talk to a consumer credit counseling or debt management or myself. So remember, when you talk to debt management, when you look up debt management online, there's going to be a lot of fraudulent activities out there. So just be very, very careful when you look up debt management company. There's some, yes, sir?
Question. What do you buy an air conditioner? And the company says, well, we'll give you free credit for a year, making payments. Then at the end of the year, you have a balance to pay on the credit card, to continue, or you can pay it off. Is that a good deal?
Well, it depends if there's interest rate on there, right? So if they're offering you a 12-month 0% introductory rate, and then at the end of that 12 months you pay off the balloon, or you continue to pay with a high interest rate, is that what they're offering you? It depends what's in your budget. So if it's in your budget to go ahead and pay, $100 a month for the next 12 months, will that pay off the entire balance? Or if you have it in your budget to pay an extra $100 or $200, making it $300 a month to pay off the entire balance and stay within that 12-month introductory rate of 0%. That will be wonderful for you. But if not, then just remember that you have to budget after the end of that 12 months. So you have to budget for a very high interest rate. Chances are they're not going to go from 0% to 2%. They're going to go from 0% to 27 to 29 to 30%, depending on who the creditor is. Oh yeah, it's always best. Yeah, well, maybe not the end, or it's always best to pay it a little bit sooner too. So that's always the best thing is to pay it when there's no interest, right? So ideally, yeah. Any questions with that? Any questions? Okay, perfect. And know when to ask for help. So when to ask for help, there's no shame in it whatsoever. When I talk to people, a lot of times they come in and they said, you know what, I feel terrible about myself. I know better. I know how to use a credit card. I was taught better than this. I have enough money to pay this off. I just don't know why, and I don't know how I got myself in debt, and I feel terrible about myself. You know what? I don't want you or anyone to come into my office or leave my office feeling ashamed about themselves when it comes to making mistakes with money. Again, that goes back to your relationship with money. How were you brought up with money? Were you one of the lucky few that were taught that, hey, this is what you're supposed to do with your money? You have to be disciplined enough, and were you taught consistently in how to do that? Or did you have to learn? Is this how part of your learning, journey? Is that you have to make mistakes first, and then you kind of learn from there. You remember, shoot, you know what? I don't want to feel that way again, so I'm going to learn from this mistake. But you know what? It's okay if you fail a few times after that too, or fail, right? Because you're going to keep learning about yourself and your relationship with money and how to deal with it later. There's some people that I do refer to different counselors. If they were in a manic episode and they spend a lot of money, perhaps they need to see a different kind of counselor too to help them through that situation and learn different coping mechanisms too, okay? So there's no shame in asking for help, is what I'm trying to say. When it comes to student loans, of course, we know about federal loans and private student loans. If you don't know what kind of loans you have, you can go to studentaid.gov or go to annualcreditreport.com. You'll see your student loans listed on there. So there's a lot of information out there in student loans right now. Again, student.gov have a lot of good information. Just to know what kind of student loans you have, what type of loan repayments you're part of, and see if you're eligible for the Public Service Loan Forgiveness Program. So look a little bit further into that. Again, there's a lot of information on studentaid.gov. So to qualify for Public Service Loan Forgiveness, Mayo is participate in this. They're a 501c3 organization. So you have to work full-time. That's for full-time is considered 30 hours plus. Is your payment plan, is it on an eligible repayment plan? Typically on the income-driven repayment program. And are your loans eligible? If it's private student loans, you probably won't be eligible for it because it's a federal loan service feature. Oh, sorry, I can go back if you need to write that down. I can go on if you want me to, I'm sorry. Yeah, yeah, no problem. So federal consolidation, is your loan subsidized or unsubsidized loans, or is it, do you want to consolidate from federal student loans to private student loans, or is it, the pros and cons? You got to outweigh the pros and cons with that too, determine what kind of repayment program you're going to be on. So if you need to talk more about your personal loans, or your personal student loans, I'll be more than happy to help you out with that too. But it's such a large chunk of information that we'll just kind of skim through at this time. I do give out, so in May I'll be doing a presentation on student loans as well, so, or June, sorry. So next month I'll be doing a presentation on student loans, so there'll be more in-depth information on there. So the pros of private consolidation, you'll make manage fewer loans, save more money with a lower interest rate. that means that you'll have more cash flow with the lower payments. The cons, you can forfeit benefits provided by federal student loans. So for example, we have the 4-year forbearance on the federal student loans. If you consolidate to private student loans, you'll lose that. Do you need to apply for the SAVE loan? Will you be qualified for the SAVE loan? The SAVE plan that they have going on right now too. So you can go to studentaid.gov and review that and see if you should participate in that. What if you can't afford to repay your loans right now? You can still be qualified for forbearance. You can just reach out to your student loan service provider, let them know your financial situation. They can probably help you put on a plan that would be best for your current financial situation. But if you need help with any of these, you can meet with me to create a repayment plan, or if you need help just talking to your student loan services provider altogether, you can reach out to me as well. When it comes to retirement and financial planning, we want you to, of course, first things first, pay off your debt. That does not mean that you should pay off your mortgage or your student loans before you invest. What paying off debt means is your high interest rate debt. So your credit cards, your personal loans that may have a higher interest rate. So if you're paying for those, if you have debt that you're paying off and you want to invest at the same time, you're pretty much kind of losing money with the interest that you're paying on those loans. So we want you to pay your debt off, most of your debt off first before you start investing. When should you start saving for college? Are you part of the sandwich generation where, kind of like me, you have a small child and you have an elderly parent, you have elderly father too? Who do you take care of first? Do you save for your own retirement? Do you save for your kids' college fund? Do you help your parents out with whatever it is they need? Or, what is the situation? What kind of journey you're at right now? So maybe you're just paying off your student loans, but now your kids are about to go off to college. Do you start, just now starting to save for college, or do you help them, co-sign for student loans? What is the best financial decision for you? Because what does that look like if you do co-sign for your kids and then you retire in about 10, 15 years? Are you responsible for that, for those student loans? So something to explore, something to ask yourself too. And life insurance. Do you have enough life insurance to cover for you and your family? Did you recently get married? Did you recently had kids, one child or twins or triplets? Is that going to be enough to cover everyone? Is it going to be enough to cover the mortgage, to pay off the entire mortgage? Is it going to be enough to send the kids to school when they want to go to school? And one thing that I highly encourage people to do, of course, besides savings, is estate planning and trust. Probate court is not fun to go through. So it costs a lot of money to go to, for some families, it costs a lot of money to go through probate court because you got to pay a lot of attorney fees to fight back and forth the probate court. So if you work for Mayo Clinic, there is a benefit on there that you have to, like an elective benefit called ARAG, A-R-A-G, or ARAG. They are a legal services company where you can reach out to them and they can help you with estate planning. They can help you set up a trust. They can also help you with, criminal stuff too. Anything with legal services, they'll be able to help you with that. But if you don't have access to that, you can just look up online and see if you can meet with someone here local, wherever you're at, to help you set up an estate planning and trust. It's really important that you have it set up. Even if you don't think you have enough in savings or in your assets, it's really important that that you put in writing what you want done with your stuff, with your kids. If you have kids that are under 18, who's going to take care of them? If you and your significant other or their parents or other parent is not able to take care of them, who do they go to? So it's really important that you have all that in writing too. Who gets a dog? Something happens to me, who gets a dog? So where does the dog go to? Does he get, $1 million of my life insurance too? They can put that in there. Long-term care, what does that look like for you? I think I heard an NPR yesterday by 2039, with Social Security, they're only going to be able to pay out 79% versus 100% for, new filers. So, you can't really rely on Social Security for your retirement anymore. So when it comes to long-term care, we all know that medical, procedures are very expensive. Are you going to have enough coverage? Do you need to start saving now? Do you need to start investing into an HSA account, a health savings account now to help offset some of the bills you have later on? When my dad had a stroke in October, his 1 month care was $9,700, and he was still able to walk. He was able to ambulate and feed himself, and he was just there to, to help with rehab and stuff too. $9,700 for a man that's able to do 80% of things himself. I was like, could you imagine just being at that nursing home for an entire year? That's $120,000. And most, you know, the average like income in Rochester is not $120,000 right now. So just think about where that's going to be. You know, how much it is, how much Medicare is going to take care of that, how much of your insurance is going to take care of that too. So it's really important to plan for long-term care. So I think Dawn is doing a presentation next week on when it comes to health and money. So it's really important that if you guys want to participate in that, just go to our website and see what kind of presentations are coming up on that. And he's a great speaker too. So when it comes to retirement and planning, identify your retirement goals and desired lifestyle. Again, do you want to travel in Minnesota or around the world? You know, that's going to require a savings technique. You know, how much you need to save by a certain amount of time. Do you contribute to your current employer-sponsored plans now? 403B with Mayo is wonderful, but do you need another retirement option? You can talk to an advisor about that as well. Do you need to open a traditional Roth IRA options too? We have that available. And understand different government benefits when you're 65, when you're 67, when you're 70, when you retire, things like that. It's really important for you to understand. Again, Dawn covers so many of those wonderful questions. Start saving for retirement as soon as possible. This kind of give you an idea what it looks like, right? So when you're 15, how'd you started saving money at 15? Which I was not saving money at 15, right? At 15, when I was working part-time, I wanted to get my nails done. I wanted to go to spend it right away, go to the movies, whatever. But if you want to save $1 million by 65, if you started at 15 years old, you only have to pay or invest $60 a month in order for you to hit $1 million by 65. And of course that goes up. If you're 25 years old, you have to start investing $160 a month for you to hit $1 million by 65. If you're at 35, you invest $440. If you're closer to my age at 45 now, or you know in the 40s, you might want to invest $1,310, you know, until at 45 to 65 in order for you to hit $1 million, right? But if you start at 55, you might want to put in $4,800 in order for you to hit $1 million by 65. So the sooner you start, the better. But for some of us that don't have that luxury, you can start wherever you're at now. It always helps. What we have available here at MEFCU to help you manage your money, keep tabs on your money 24/7. We do have online banking. We have mobile banking and mobile deposit. It's a wonderful, easy feature. Bill pay, digital wallets. We have Zelle, person-to-person transfers, internal and external transfers, e-statements. You can open accounts and apply for loans online. You can do a video chat. You can just do a regular messaging chat, a phone call with our representatives. We can set up customized alerts to monitor your accounts in case there's fraudulent activities and scams. So I'm going to throw up some facts out there. Again, next week, Stephanie is doing a wonderful presentation on scams and frauds. So don't let anyone scam you out of your hard-earned money because, again, no one is immune to scams. It happens to all age, you know, demographics. It can be, I've dealt with scams from a 15-year-old all the way up to, you know, 105. So whatever demographics you know, if you don't think you're in the right demographics to get scammed, trust me, we all are in the right demographics to get scammed. So some common facts are out there. So last year, scam snapshot of 2023, 2.6 million fraud reports, $10 billion reported loss. As you can see, but this is not, you know, if everyone just reported all their losses, I'm sure it's gonna double or triple. Sometimes people get really embarrassed when they, you know, get scammed or get defrauded. You're like, I'm supposed to know better. You know, just trust your intuition. Every person that I talked to, they got scammed, said that there was a split second that happened where they think, maybe this is a scam, maybe this is too good to be true. And they should have trusted that. And every person I talked to, you know, they all have that little thing running in their head that, you know, I know better. I thought that it was a scam, but I still went for it. And they're really good. These people work in teams. They know exactly what to do. There's so many different scams out there. AI now is, you know, taking over the world, and it's just it's really easy to fall for certain scams. And don't think that, you know, don't question yourself, you know, why did I fall for this? Like, I knew that I shouldn't fall for something like this. I should be smarter. But no, they're just really good at, in advance about it. So, but any questions on scams or anything we talked about today? No? Nothing? Wonderful. So again, my name is Soka Yus. I'm a financial wellness counselor here. My phone number and my email address will be on our website as well. So if you have any personal questions or any questions afterwards, go ahead, sir. Yeah.
If you have a CD, and it's say it's a 2-year CD, and you die 9 months into it,
Uh-huh.
and you have a beneficiary on it,
Uh-huh.
does your beneficiary have the right to
I believe they have to collect it at that time because since the CD is under your name, and so it's only under your name, unless it's under your beneficiary's name on there as well. But if it's only under your name and you have a beneficiary, in case something happens, then I believe they have to collect it at that time or after probate courts clears up. So it's always best to maybe put their name on there too. So, and again, every few months or every year, I highly encourage people to have a list. Just list where all your finances are at. What bank, what institution they're with, what credit union, what's that bank account number, who the beneficiary is also, and also update your beneficiary. Did you recently get married? Did you recently get divorced? You know, if you get divorced, you might want to update your life insurance or your banking beneficiary as well. So it's really important to review those things each year or per life events as well. You know, do you want to add your newborn child on there too as the beneficiary? When you open up a 529 plan, are you the main beneficiary or the main, you know, or do you want to add someone else as the beneficiary as well? So it's really important to review those things. Okay. All right. Well, thank you so much, everyone, for joining us today, and I hope you stick around for Cameron. He's giving a presentation on buying vehicles next year at about 12:15.